my whole podcast channel, I have like 50 videos about MSTR, and I've dived deep into like all the treasury companies, or not all of them, but lots of them. And so, I feel comfortable holding positions of them in certain aspects of my portfolio. And then, I've got a leveraged play going on right now where I've actually taken out a really small collateralized loan of my Bitcoin, just a small chunk of Bitcoin. And then I've moved that into, in Canada here, we have a tax-free savings account, so we can get dividends at a tax-free rate. So my whole concept and theory with this portfolio, or this trade that I'm doing, is hold MSTE, which is a leveraged version of MSTY, which is a yield bearing instrument off of MSTR. And then
wait a minute. I thought I was degen with my MSTY position. There's a MSTE that leverages MSTY.
It's only in Canada. So in Canada, there's MSTY, right? MSTY, but it's structured differently. It is not a synthetic covered. It's not a synthetic long covered call position. It's shares, and they sell covered calls on 50% of the holdings. So
okay.
So MSTE
so
is
not based on MSTY.
No, different.
Okay.
Slightly different. So MSTE is based on the Canadian version of MSTY. So it's 25% leverage on that strategy, the traditional covered call strategy. So then the idea there is you take those dividends and you buy Bitcoin with it, and you add that to the loan to value collateralized Bitcoin to lower the loan to value, and then you can take out more equity on that, or more cash out on that loan that you've created, and then buy MSTY with that. So it's this compounding leveraged effect with the dividends adding Bitcoin. And then because of that, you're able to take out 50% of that in cash. And then you add that cash to MSTY, and you just do that over and over and over.
We got to break. So what do you see about the dangers? This is really interesting because now you're talking my language. So what are the dangers, right? This is a risky play.
Oh,
course, right? Leverage upon leverage upon, like, you don't know what could happen, black swan timing and all this stuff like that.
Yeah, the risk is the same with any leveraged play, right? It's leverage unwinding. So what could happen is if there's a black swan and Bitcoin drops like crazy, if you have a collateralized Bitcoin loan, you're going to have to add Bitcoin to lower your loan to value. Otherwise, you're going to get liquidated. There'll be a forced liquidation period price at 80% loan to value. They liquidate your Bitcoin with the service I'm using, and then they pay the loan off and send you back the rest. So you don't want that to happen, right? That's a forced seller moment. So that's something you want to protect. You want to protect your loan to value ratio so that you're not having a margin call situation. The other risk there is that you're holding a derivative play on Bitcoin that pays dividends, pays income based on volatility harvesting. So even now, I'm sure you've seen a lack of, or like a lower amounts of payouts on the American MSTY. The Canadian version of MSTY and MSTE have both lowered their monthly dividend by a percentage, and that's because of the lack of volatility within MSTR that they're structured on. So that's a big risk, is they pay high dividends because they're volatile. It's a volatile stock, and that's when you sell covered calls, a huge part of the premium is based on volatility, and the volatility is dried up a little bit on MSTR. Doesn't mean it can't come back.
On purpose.
Yeah. And
seller at all. They're doing it on purpose. Yeah.
Yeah, and I think they're re-leveraging a little bit now, not hitting the ATM, and they're aiming to have more volatility in their stock. I think he wants more volatility. So I think with that, we're probably seeing the trend of maybe a bottoming of volatility in Bitcoin and MSTR. So with that volatility increasing, these yield products become more attractive in that way. You're also capping your upside, so there's opportunity cost there. But I would say the biggest full risk is sort of a volatility crush on these yield instruments. And then of course, with what I'm doing, the additional risk is that you don't manage your loan to value right. And you're over leveraging.
Yes, that's the crux that make everything collapse.
Totally. Yeah.
in that scenario.
Yeah. And then maybe Bitcoin underperforms the interest rate that you get on something like this. Like there's a lot of variables here, right? But I don't see it, like I see those risks as being pretty minimal. And then again, this is like an experiment for me. This is like a fun experiment. I plan to make a video on the entire process. And then, if the loan to value got really, started ramping up and going higher because Bitcoin's price was going lower, no problem. I could put more Bitcoin in there and just let it sit and not get liquidated because it's
so. Let me get this
loan.
straight. You take the loan out, right? Let's say, just hypothetically, 10,000 worth of Bitcoin to get 5,000 fiat. You take that 5,000 fiat, you go buy MSTE.
Correct.
Right? You get the dividends monthly or quarterly?
Monthly.
And then you feed that back into the loan.
Correct.
To increase your collateral and then request more loan out.
Yeah.
And with that extra secondary loan, you then buy MSTY. Okay. now we're out into on a cliff, right?
And so you're acquiring
with the MSTY dividends. What do?
You buy more Bitcoin.
Straight Bitcoin, and then you put it back into the loan?
Yes. It's a feedback loop. It's a feedback loop. So you're doing two things. You're acquiring, so you're with the dividends, you're acquiring Bitcoin and increasing your loan to value or lowering your loan to value, increasing the value held in collateral. And then with the loan, the additional loan amount that you're able to take out, you're buying MSTY. So you're increasing your shares of MSTY, you're increasing your amount of Bitcoin, and it's compounding on itself.
Okay.
And the reason I'm doing this as well is, again, we have a tax-free savings account where dividends aren't taxed. So I think if you didn't have a tax advantage system here and you were doing this with MSTY in America, it wouldn't
be as advantageous.
No, it might just make sense. And they literally, I'm using LEDN to do this. I'm not affiliated with them or anything. It just happens to be what I believe is the most trusted system to do this on. They also have a product where you literally take out a loan and it buys Bitcoin and just adds that to your collateral right away. And it's just
B2X or something like that.
Yeah,
right?
something like that. Yeah,
BX.
Which would probably be better than buying MSTY and not having the tax advantage dividends. I would say that would probably outperform.
Right.
Just buying Bitcoin with the loan.
I think it would be a great time to do that if anyone could. Not financial advice. This is financial entertainment, edutainment, I should say, like KRS-One used to say. So that's an interesting play, man. That's deep down the rabbit hole. Please, users at home. It's professionals. Please do not try at home unless you've been properly trained, okay? This is a big boy's game, like Peter Dewan said on my last podcast. This is a big boy's game.
And
if you know.
And like I said at the beginning of this, the biggest risk to, the riskiest thing for people is getting involved in something that they don't fully understand. So this is complicated. So don't just listen to this one thing that we've talked about here and think, oh, I'm going to go do that, because you're going to make mistakes, and those mistakes can cost you a lot of money. And again, and the other thing too is with leverage. I mean, this is just general advice around the board. You do a very small amount compared to your stack, right?
Right.
5% leverage or something, like just go super low.
Yeah.
If you're going to mess
super
with that.
Low. Yeah. Single digits.
Yeah.
Super low.
Yeah.
Because you never know what can happen. But it's interesting. I like it.
Yeah.
For sure.